For over a century, through every economic disaster imaginable, only three financial assets have consistently survived. And by the end of this, you'll know exactly what they are, and why the world's wealthiest individuals are loading up on them right now. There is a rhythm to financial chaos. The Great Depression, which erased nearly 90% of stock market value. The stagflation of the 1970s that crushed bonds. The global meltdown of 2008, the panic of COVID, and the brutal rate shock of 2022. 5 distinct catastrophes: deflation, inflation, systemic collapse, a pandemic, and aggressive tightening. Yet through all of them, the same trio of assets held strong. Not 5, not 10, just 3. The exact same 3 that protected investors in 1929, worked in the 1970s, survived 2008, and outperformed again in 2022. One of them is so essential that Warren Buffett has parked over 30% of Berkshire Hathaway's portfolio inside it. The second is being accumulated by central banks at a pace we haven't seen in decades. And the third has quietly delivered nearly 10% average annual returns for more than 100 years through every crash and recovery. Survival, not speculation, is what builds generational wealth. These are not complex derivatives or secret hedge fund schemes. They are simple, accessible positions. But most people ignore them. Instead, they chase hype, buy at the top, and panic sell at the bottom. They fail to recognize the pattern. A pattern that proves, no matter the crisis, war, peace, inflation, or collapse, these 3 assets preserve capital. They allow steady compounding. And more importantly, they put you in position to buy assets for pennies when everyone else is forced to sell. Today, I'm going to show you exactly what those 3 positions are. We'll analyze their performance across 5 very different economic disasters, and I'll explain why the most sophisticated investors on the planet are aligning their portfolios with this exact combination, right now. Understanding this doesn't give you a crystal ball. It gives you something better: durability. The certainty that when the storm comes, you won't just survive it, you'll emerge stronger. But first, let's answer an important question. Why 3? Why not 1 ultimate safe haven, or 20 diversified bets? Because the global economy always operates in one of 3 states. State 1, deflationary collapse. Prices fall, assets crash, liquidity becomes king. State 2, inflationary destruction. Currency loses purchasing power. Only hard, real assets remain safe. State 3, growth and recovery. The economy expands. Ownership in productive businesses creates wealth. Every financial crisis in modern history fits into this framework. The Great Depression was State 1. The 1970s were State 2. 2008 began as State 1, then shifted to State 2 as money printing exploded. If you hold all 3 keys, you stay protected, no matter which door the economy walks through. This is the foundation of what Ray Dalio called the all-weather portfolio. The purpose isn't to win in every season. It's to survive every season. Because the investors who survive the crash are the only ones left with capital to buy at the bottom. And that's where real fortunes are made. Let's go back to the ultimate stress test, the Great Depression. From 1929 to 1939, the world was in a deflationary nightmare. Cash and short-term government debt became more valuable because prices were falling. Those with liquidity didn't just survive, they gained purchasing power. Treasury bills continued paying interest while everything else burned, creating real returns of more than 25%. Gold rose violently in value after the U.S. government revalued it in 1934, from around $20 per ounce to $35. Gold holders saw an instant 75% gain, not because gold changed, but because paper money was devalued around it. And the third position, the S&P 500, or technically its predecessor. Yes, it fell nearly 90%, and that part is painful. But those who held on, while reinvesting dividends, fully recovered by 1945. And over the decades that followed, their wealth multiplied many times over. 3 positions: cash for survival and opportunity, gold for protection against currency debasement, and stocks for long-term growth and recovery. Now flip the script. The 1970s brought the opposite disaster: runaway inflation. In that environment, cash itself was weak. But short-term treasury bills adjusted their yields upward, eventually exceeding inflation. By 1981, they were paying over 15%. While long-term bonds collapsed, T-bills preserved capital. Gold exploded in value. Stocks initially struggled, then surged as inflation stabilized. Once again, the same 3 positions adapted to a completely different environment. They preserved capital while long-term bonds were slaughtered. Gold. This was its masterpiece. Gold soared from $35 an ounce to $850, a 24-fold increase. A 10% allocation could have become half your portfolio. The S&P 500. The index was flat for 14 years in nominal terms, a brutal period. But with dividends, returns were around 6% annually, though still below inflation. The key? Those who held were perfectly positioned for the epic bull market that began in 1982, which delivered 17% annual returns for nearly 2 decades. The same 3 assets, a completely different crisis, the same outcome: survival and eventual prosperity. The 2008 financial crisis, a near-total system failure, cash and T-bills. When Lehman fell, liquidity vanished. Cash was king. Warren Buffett's massive cash hoard allowed him to make legendary high-yield deals with Goldman Sachs and GE, earning billions. Cash provides optionality when others have none. Gold. Initially, it dipped as everything was sold for liquidity. But then the Fed launched QE, printing trillions. Gold reversed and soared, anticipating the currency debasement to come. The S&P 500. It fell 57%, a brutal, gut-wrenching drop. But if you held on, the market recovered all losses by 2013 and then embarked on a 400% bull run. Selling was the permanent loss. Holding was the path to recovery. The COVID crash of 2020. The fastest crash in history. Cash and T-bills. With dry powder, investors could pounce. Some hedge funds made billions on credit swaps and then bought stocks like Starbucks and Hilton at 50% discounts, doubling their money in months. Gold. It dipped briefly in the panic, then rocketed to new highs as global stimulus measures poured in, a direct bet on coming inflation. The S&P 500, a 35% crash in weeks, followed by an even faster V-shaped recovery. Those who held were made whole, and then some, incredibly fast. The 2022 bear market, a rate shock transition, cash and T-bills. This was their moment to shine. T-bill yields exploded from 0% to 5%. You earned a real return while stocks and bonds fell dramatically. Gold. It was flat to slightly down for the year, but it didn't crash. It preserved value, and then began a new rally in 2023. The S&P 500. It fell 18%, but a well-balanced 3-position portfolio might have been down only single digits, massively outperforming. 5 different disasters, one consistent outcome from the same 3 holdings. So, what are these magical assets? Let's break down their eternal roles. Position 1 is cash and treasury bills. Its superpower? Optionality. Think of this as financial oxygen in a crisis. It's not designed for earning high returns. It's designed for having the power to act when no one else can. Warren Buffett currently holds a record $150 billion in cash and T-bills. That is his dry powder, just waiting for the right moment. Position 2 is physical gold. This is the ultimate insurance policy against fiscal irresponsibility. It can't be printed. It can't be inflated away. For 5,000 years, it has held its value. Today, central banks are buying over 1,000 tons per year. That is a clear signal of distrust in the global fiat system. Remember, gold isn't an investment. It's a lifeboat for your purchasing power. Position 3 is the S&P 500 index. This is your engine of long-term wealth compounding. It represents ownership in the most innovative and resilient companies on Earth. Despite every war, every recession, and every crash, it has provided roughly 10% annual returns over the long term. The key here is the time horizon. You must be able to ride out the volatility to capture the growth. Part 2. The strategy. So, how do you implement this today? Here is a model allocation based on your life stage. If you're under 40, go with 20% cash or T-bills, 10% gold, and 70% S&P 500. You have time on your side for recovery and massive growth. If you're between 40 and 60, adjust to 30% cash, 10% gold, and 60% S&P 500. This is a more balanced approach. If you're over 60, move to 40% cash, 10% gold, and 50% S&P 500. Here, you are prioritizing capital preservation while keeping solid growth exposure. To execute this, for position 1, use a treasury money market fund. For position 2, buy a physically backed gold ETF like GLD. And for position 3, buy a low-cost S&P 500 ETF like VOO or IVV. Set up automatic investments and stay disciplined. Part 3. The conclusion and CTA. Now, a quick disclaimer. This is not financial advice. This is a century of pattern recognition. Always consult a professional for your personal situation. But the pattern is undeniable. The smart money is already positioned. Buffett's record cash pile, central banks' relentless gold accumulation, long-term investors steadfastly holding equities. The next crisis is a matter of when, not if. So ask yourself, will you be the investor panicking, selling at the bottom, and locking in losses? Or will you be the one who sees the pattern, holds the 3 positions that always survive, and uses the chaos as an opportunity to build lasting wealth? If this pattern makes sense to you, if you see the wisdom in preparing for storms rather than just hoping for sun, then hit the like button and make sure to subscribe to Financial Drift Analysis.